High earners owe high taxes. That is part of having a progressive tax system. And even if it were a flat tax system, that would still be the case. But it's especially the case with a progressive tax system. So if higher earners don't want to lose 25 to 50% of their income to federal, state, and local income taxes, they need strategies. And that is where real estate can really shine. So we're going to jump through today 7 strategies for real estate investors or anyone with a higher income to curb their taxes, and plus 2 bonus strategies as well that we will mention, but not dive completely into. So on that note, welcome to the Bucks Outside the Box show, where we challenge conventional money advice. We get a little contrarian and try to think outside the box. Denny, let's dive right in and talk about the first one, which is one that everyone has probably heard of. We're not going to spend a ton of time on it, but why don't you start us out with the 1031 exchange?
Well, I mean, that's a good way to transfer property to property, but it's takes a very long time, and there are so many steps. I've worked with people as a realtor who had to do that, and it's becomes quite a headache.
Yeah. So and when you say it takes a long time, what Denny is really talking about is the labor involved on your part. The amount of time that you have to personally invest in it, as opposed to like calendar time. And in fact, there are very strict rules on how short that calendar time has to be, and when you have to have certain things done. So for anyone
Yes,
who's
I
not,
meant time and preparation.
yeah, exactly.
Meet
So
the deadlines.
right, yeah, deadlines. So with a 1031 exchange, first of all, you have to hire a qualified intermediary to take all the money. You can't touch the money when you do a 1031 exchange. So for anyone who is not familiar with a 1031 exchange, it involves selling one property and using the proceeds from that to buy another larger property. And it does have to be more expensive. You have to spend more on the replacement property. And when you do that, your capital gains from the property that you sold are not taxed. You don't have to pay capital gains taxes on that. So what you can do is you sell property A. Let's say that it's a single family rental property. You sell that property and you go out and you buy a fourplex. You're upgrading to a fourplex that will cash flow better for you. So you have to hire a qualified intermediary who's a professional who handles the money for you for this transaction. You have to declare at least 1 and up to 3 possible replacement properties within 45 days. And then you have to actually close on one of those properties for the replacement property within 180 days. And you can't touch the money. Only the qualified
Mhm.
intermediary can touch any of the money. And then they charge fees, by the way. That's not free. They don't do it out of the kindness of their hearts. This all costs money, and there are a ton of legal forms you have to go through. And like Denny said, there's a lot of just labor and time and headaches and red tape involved on your part.
And there's things that can go wrong, and that makes it stressful. And properties sometimes don't close. Then you have
Yeah.
that issue.
Yeah, absolutely. I mean, sometimes you discover problems behind the walls when you do an inspection for the property, or whatever the case may be. But that being said, it is a classic strategy for growing your portfolio over time while deferring taxes. And of course, when you sell the final property and don't 1031 exchange it, all those back taxes come due. You got to pay the piper. But it is a great way to, take a single family, go to a fourplex, and then take that and
Right.
go to an eightplex, and sell that and go to a 20-unit apartment property, and keep kind of scaling it up and growing your rental income over time without having to pay a bunch of taxes along the way. So it's a tax efficient way of growing your income property portfolio.
So, with that being said, Brian, tell us a little bit about an alternative.
Yeah. So what you and I do in the co-investing club is we practice something called the lazy 1031 exchange, where you don't have to do any of that stuff. All you have to do is when an outgoing property sells, often a passive real estate investment like a syndication, all you have to do is invest in a new one within the same calendar year. So, in June, a syndication sells, pays out the profits to you. You owe back taxes for depreciation recapture, for the capital gains tax, on those profits and gains. And then let's say in November, you see another syndication deal that you love, and you take the money that you made from the old one, you invest it in the new one, and you get, the huge depreciation write-off from that new investment that you made. And that big write-off from depreciation in the first year or two, that helps knock out those gains and back taxes and depreciation recapture from the old one. Maybe not
And
entirely.
no intermediaries.
No qualified intermediary that you have to pay. No 45-day rule or 180-day rule, or legal forms, tax forms, red tape. None of that stuff. You're just investing in a new syndication in the same calendar, so that the on paper losses from the new one from depreciation can offset the gains from the outgoing. It's literally that simple. And we mentioned the co-investing club. Yeah, that is Denny's and my business. We organize an investment club called the Co-Investing Club, and we specialize in passive real estate investments. So that is syndications, of course. It's also funds. It's also private joint venture partnerships. It's also private notes. Excuse me. So it's a mix of different passive real estate investments with different tax benefits for each one. But this is a way for people to not only have consistent deal flow. We look at one or two of these every single month together on a big group video call. We also vet
And
them.
doing it together so you're not like in this alone.
Right. So we vet these together so that you get the benefit of dozens of other investors' experience and expertise in vetting these, so that you're not stuck wondering, well, I don't really know how to, vet a syndication or a private silent partnership. Yeah, what's the risk in this? I don't know. Fortunately, there's 40 other people on that call who do know. And we're all grilling the operator together and, discussing the risk and analyzing the risk together. And then, of course, we go in on it financially as well, so that each person can invest a much, much smaller amount than you would have to otherwise. So the typical minimum investment for these types of investments is normally in the $50,000 to $100,000 range, which is a good chunk of change, right? I mean, that's comparable to what you'd have to put down for a rental property between down payment, closing costs, initial repairs, and so forth. Um, when you go at these with other people, when you go in on them together, the minimum investment in our club, for example, is $2,500, depending on your membership level. So it makes it a lot easier to just do these month after month, or at least every quarter, or however frequently, and it makes it much easier to do a lazy 1031 exchange. And we look at this through the
And
lens.
oh, sorry.
We look at this through the lens of dollar cost averaging. So, just continually investing relatively small amounts in real estate, just like we invest small amounts in stocks every month. Anyway, Denny, what were you going to say?
Well, I think it's cool because I didn't even know until we started this club about investing with SDIRAs, and quite a few people do that in the club. So talk about that a little bit, Brian.
Well, that is the perfect segue, of course. So that is number 3 on this list, is self-directed IRAs. You can defer taxes indefinitely by investing in real estate through a self-directed IRA. It works just like a normal IRA, but you need to hire a custodian. And technically, there's a custodian for your regular IRA too. That custodian just happens to be your investment brokerage, right? So with a self-directed IRA, there are a handful of specialty custodians who this is what they specialize in. This is what they do. And we have our co-investing club members get some discounts on some of those, but they help you with the paperwork for these. And it's the same contribution limits. I mean, the tax benefits, the contribution limits, those are all the exact same for a self-directed IRA as for a normal standard IRA through your brokerage account. And there is a Roth option for these as well, if you want to pay the taxes one time upfront and then let those investments compound tax-free into the future and then withdraw the money tax-free in retirement. There is a Roth option for self-directed IRAs as well. So we're recording this in 2026. The limit for people under 50, the contribution limit is $7,500. For people 50 and over, it's $8,600 contribution limit for the year. Again, same limit for standard IRAs as self-directed IRAs. And you can go out and buy rental properties if you want in a self-directed IRA. You can invest in syndications or private partnerships, private notes, any of the above, funds, all of that. You can even go into alternative investments like oil and gas or uh,
Silver and gold.
yeah, I mean, so there are some restrictions on what you can and can't invest in. Like you can't house hack, for example, with your self-directed IRA. Um, but yeah, you can invest in almost any investment that you want through a self-directed IRA.
Brian, can you set these up for kids? Because I believe there are people in our club that do that.
Yes. So here's the thing: you can do this for your children. Children can have an IRA, and in particular, you want a Roth IRA for children, since they're not really paying taxes anyway. But 60 years from now, when they go to retire, that money will have hopefully compounded, to millions of dollars, right? I mean, it has 6 decades is so much time to compound that, I mean, they can become millionaires just from the contributions that you helped them make when they were children to their Roth IRA. And again, whether that's through your brokerage or through a self-directed IRA, you can do that for your kids. Here's the caveat. Here's the catch. They need to have taxable income because the
Mhm.
contribution limit for an IRA it's not just a firm $7,500. It's the lesser of $7,500 or your taxable income. So,
Okay.
for the average adult, obviously that doesn't really apply. But for children, that is a big limit. So they can only contribute the amount of taxable income that they had throughout that calendar year. Now, you can employ them, for example. You can employ them in your business if you have a business. You can employ them around the house. We so there are people like so the biggest hack for this is you've got these social media like influencers out there who pay their babies to be models for their Instagram channel or whatever. And and they pay them $7,500 a year to be a model for their little social media empire.
I mean, that's pretty creative.
It's super creative, and so their baby gets the full $7,500 in income, and then they get to contribute that to a Roth IRA for them. And I wish we had run the numbers before recording this, but if you were to contribute on your child's behalf the full contribution limit from the time they're born until the time they turn 18, that will have compounded, at the sort of standard 8 to 10% that the S&P 500 returns. That will have compounded to millions upon millions of dollars by the time they turn 65. So it's really powerful. And I've seen that math before. I wish I wish we'd pulled that up for this particular episode, but many millions of dollars. And that's assuming they never invest another cent, never contribute another cent throughout their entire working career.
That's crazy.
It is crazy. It's so powerful. So my daughter is about to turn 6 in a couple weeks, and
She will be a model.
well, so I'm going to start employing her around the house and maybe even for Spark Rental. Don't worry, Denny, I won't pay her out of company money. But yeah, I mean, because this, you can pull money penalty free out of your Roth IRA for things like college education. So it's a way more flexible way to invest than say a 529 plan, right? You can pull money out with some caveats for a down payment on a house. So that
That's
money that I invest for her today, tax free, for her can be put towards her college education, can be put towards her down payment on a house eventually, and of course, for her retirement, 6 decades from now. So really powerful. And it's on my to-do list for this month, actually. Get that set up for her. Okay, moving right along. We won't spend a ton of time on this, but the fourth one is a solo 401k. So if you are self-employed, you can go to one of those same custodians that you would go to for a self-directed IRA. You can open a solo 401k, which is basically the 401k version of that self-directed IRA. So same tax benefits. You can either open a traditional 401k or a Roth 401k through a custodian. The contribution limit is way higher for self-employed people in 2026. The contribution limit is $72,000 if you are under 50. If you're over age 50 or 50 and over, it's $83,250. as a contribution limit to a solo 401k. So obviously a much higher limit on these. It does typically cost a little bit more in custodian fees to set that up,
Mhm.
but
It's a little bit more strict. Like there's rules and things that you have to follow, and so you got to make sure that you get right on it.
no question. But that's basically an expanded option of what we were talking about with self-directed IRAs. For now, you do have to be self-employed to take advantage of that. And you also do need to have that much taxable income from that self-employed business to be able to contribute. Because again, it's the lesser of either that hard limit or your earned income through that business. Okay, moving on to number 5, backdoor Roth contributions to your IRA. So this is in a similar vein here. Um, the way this works is if your income is too high to contribute to a Roth IRA, you can still contribute to your Roth IRA and get the tax benefits.
You
So
just go in the back door.
you go in the back door, and the back door is your traditional IRA. So you make the contribution to your traditional IRA. Your income is too high for you to get the tax deduction for the traditional IRA contribution, right? But you can then do a rollover or a conversion, I
Mm.
believe they call it, the technical term. You convert that money from your traditional IRA to your Roth IRA. And and you've already paid the taxes on that money. So you don't have to pay the taxes during the conversion like you would ordinarily have to do with money that you had previously written off. But then the money ends up in your Roth IRA. It can then compound tax free, and you pay no taxes on withdrawals in retirement. So, if that was confusing at all, talk to your CPA about it or your financial advisor about it. We've partnered with a financial advisor, Michael Harris from Emory Wealth, to offer a fractional family office service in our co-investing club. We can talk more about that later, I suppose, because that is really fun. Uh, we just finalized that partnership with him. We just announced it to our co-investing club members last week and had our first people join, which is really exciting. So anyway, yes, backdoor Roth contributions absolutely an option for you if your earnings are too high to contribute to a Roth IRA. But talk to a financial professional about it to get a little bit more direction because there are some rules and caveats for it. Okay, number 5, use an HSA, a health savings account, as a secondary retirement account. So HSAs have the best tax benefits of any tax advantaged account in the United States. Triple tax benefits. So you get the best of both worlds between traditional and Roth IRAs with an HSA. So the money that you contribute to an HSA, tax deductible. You can deduct that from
Mm.
your taxable income. It also compounds tax free like a Roth IRA. And then when you withdraw money for qualified health related expenses, also tax free. So triple tax benefits for an HSA. Now,
But can you use that as an investment?
yes. Yes. So there's a couple types of HSA accounts that you can open. One works more like a savings account, and the other works like an investment brokerage account. So you can invest in stocks and index funds and that sort of thing. Funds that mirror the S&P 500, that sort of thing, in your HSA. So
I just learned something.
yeah, super powerful. Now, here's the one drawback to HSAs. You have to have a really crappy main health insurance policy in order to qualify for an HSA. And we're not going to get into the details of that here, but it has to be a high deductible health uh, insurance account that you have. And that the deductible is pretty high. So you're not going to get like the copays and like the you're not going to get all the benefits of a really good, expensive health insurance policy, and then still qualify for putting money in an HSA. An HSA is meant to be a companion account for a very high deductible health insurance
Right.
policy. So you're going to need a pretty low frills health insurance policy in order to qualify to open an HSA. So that's the drawback. And that was something that my wife and I struggled with that decision for our own family. Obviously I'm self-employed. Denny and I are the two co-founders of Spark Rental and the co-investing club. My wife works as a W-2 employee. She gets pretty good health benefits for herself. However, the health benefits for her spouse and our daughter are not very good. They're not nearly as subsidized by her employer, which is a very common thing in the private sector where employers want to offer pretty good health benefits for their employees, but they don't want to be coming out of pocket for their employees' spouses and children and all that stuff. So they make the benefits much less attractive for spouses and children, which is what her company did. So we had to decide, do we want to, pay for myself and our daughter Millie on my wife's account, or do we want to access the HSA and just get a high deductible policy for me and my daughter? And we ended up choosing the latter. So we did open a high deductible health insurance policy for myself, my daughter, because we're both healthy. We don't have, a lot of healthcare needs, knock on wood, Uh, and then that enabled us to open an HSA, which we are maxing out every year to get these amazing tax benefits from it. But it was a
That's
conversation in our household. So anyway, uh, again, talk to a financial professional about that, and maybe your insurance professional as well. Although, of course, they're always going to pitch you on the more expensive policy. But uh, yeah, or talk to your fractional family office manager. In our case, Michael Harris, who you can check out. He can talk you through that as a financial advisor and someone who has a lot of connections in the insurance space. He's qualified to write certain types of insurance policies, not others.
yes.
But the point is being he's very well versed in insurance underwriting, um, and he can talk you through the pros and cons of those strategies. All right, we got to keep moving this along. That was number 6. Number 7 here is start a business, or even if it's just a side hustle, because then you can write off a lot of expenses as business expenses, and those become tax deductions for you that otherwise, if you wanted to deduct for those, you would have to itemize your deductions. But when you own a business, those can become business expenses, which are, of course, deductible from your bottom line taxable income from your business, while still taking advantage of the very high current standard deduction, right? Because, if you're just dealing with personal expenses, you have to choose, do I take the standard deduction, which today is quite generous, or do I itemize my deductions to take,
Huh.
to write off the home office and the other, mileage and stuff like that. If you have a side hustle business of some sort, then you can take a lot of those expenses that you would have to choose between, itemizing versus taking the standard deduction, get the best of both worlds. You can take the standard deduction for your personal uh, deductions and expenses, while also moving over a lot of those expenses to your business and then being able to deduct them there too. So,
And then isn't there extra advantages if your business happens to be real estate related?
uh, yeah, they were getting outside the scope of this particular episode. I don't know I mean, do you want to talk about some of those, or do you want to save this for another episode?
We could save them for another episode, but that is something, one could keep in mind.
Yeah. So, I mean, you can write off things like travel to and from your properties if you're a landlord, for example. As a business owner, you can write off a home office. You can write off childcare. I mean, there are things that you can write off, and sometimes you can put health insurance under your business as well, make that deductible. So there are some very clear advantages to having a business, even if you still work a full-time job as a W-2 employee. You can end up writing off more by having a little side hustle that, maybe it's a hobby business. Maybe it's something that you would be doing anyway,
Right.
because you love it. But it brings in some extra money, and then you can knock out taxes on that extra money with these deductions. Okay.
So it's really about being creative.
It
And there are
is-
so many ways to be creative and so many people you can reach out to help you be creative.
Yeah, absolutely. Within the confines of the law, of course. And when
Oh
in
yeah.
doubt, talk to either your financial advisor or your CPA about this stuff. So those were the 7 ways to defer or lower your tax bill through real estate, and particularly on real estate gains. So we'll just rattle them off real quick to summarize. 1031 exchange, lazy 1031 exchange, invest with a self-directed IRA, invest through a solo 401k, use the backdoor Roth contributions, open an HSA as a secondary retirement account. And one thing we didn't mention with that is that in retirement, you're going to have plenty of qualifying healthcare expenses, right? There will be no shortage of opportunities for you
Mhm.
to withdraw money from your HSA in retirement for qualifying health related expenses. And then number 7, start a business and write off deductions there while still taking the standard deduction personally. Now, we've got 2 bonus ones for you that we're not going to dive too deep in on because, again, they're a little outside the scope of this, but you can do something called a 721 exchange for your properties, which is very lesser known. And we're not going to dig too deep into the details here, but it's also called an UPREIT exchange. And what you can do is you can sell your ownership in a property or through a partnership. And if you structure it right, you can move that money into a REIT or some kind of new partnership tax free, similar to a 1031 exchange. But instead of going property ownership to a new property ownership, you're going from property ownership to a passive real estate investment, such as
Okay.
a REIT or a partnership. And this is something that, Denny, you and I should look into the mechanics a little bit more in case we can offer this to, more directly and specifically to some of our co-investing club members. Uh,
Yeah.
but so here's an example of a company that offers this. It's called Flock, and it's got its pros and cons. But the main thrust of it is you sell your rental property to them. Your rental property goes into the REIT, basically. It goes into this fund, and you, instead of getting cash for your rental property, you get shares in that fund or
Oh,
in that REIT, basically. So then that becomes a passive investment. You get the distributions, or I guess it's a dividend if it's a REIT, technically
right.
speaking. You get the dividends every quarter from that. As the REITs uh, portfolio grows and shares grow in value, your shares, you get the benefit of appreciation and growth there as well. And then they have a rather unclear option for you to actually liquidate your shares. And that's one of the challenges with crowdfunding in general. And this is really set up like a crowdfunding platform, just with kind of a
Okay.
novel
Okay.
twist. But um, the other problem with Flock, aside from how murky it is for how you actually cash these out eventually, is the high fees. I mean, they charge a 6% fee when they buy your property from you. They charge another 1% asset management fee every year. I mean, they hit
Wow.
you with a bunch of fees that, some of which are probably hidden. And that does not include property management fees and other fees that they're charging. They probably have in-house repair crews that they can charge whatever they want for, right? Because they're not being bid out or competitive. So, these are sort of the challenges with crowdfunding platforms in general, is that there ends up being all these hidden fees aside from the stated fees, which themselves can be quite high. So, uh, that's bonus option 1. Um, Bonus option 2 is putting your property into a charitable remainder trust. So you don't pay taxes on the gains from that because the gains go to a charitable trust, basically. And this is something that, this is outside the scope of what we're going to talk about today. This is really something you need to talk through with an estate planning attorney. But that is part of the service of the fractional family office that, we are now offering through the
Right.
co-investing club. So, a fractional family office service has all these different pillars, these financial pillars that they help you through. So things like investment advice and portfolio planning, yeah, and rebalancing all that stuff there, tax strategy, tax advice, uh, you know, both public
Estate.
investments and private investments, like the kind of stuff we do in the co-investing club. Um, like you said, Denny, estate planning and the legal side of things, uh, cash flow management and planning, and, all of those sorts of pillars, that requires a team of different financial experts. And then you have one person in the middle of that wheel, who works with all the different experts. And that financial advisor who we partnered with for this is Michael Harris. But he manages all those other different experts within your little family office, basically.
Right.
So this is how the wealthy manage their money with a team of experts called a family office. Obviously, that's really expensive to do. And we looked up.
Expensive, but it also has savings and definite good aspects to it.
Yeah, yeah. This is what the ultra wealthy do, and we ran the numbers. So the average single family office, like dedicated family office for the wealthy, costs $3 million a year to run. For a multifamily office, those costs average between $100,000 and $300,000 a year to run. It's obviously really expensive. For a typical, it's just successful like, upper middle class person, that's not possible, right? I mean, we offer that as a fractional family office service for obviously a tiny fraction of that cost as one option for membership in the co-investing club. There are, of course, other options as well for the co-investing club if you just want access to the passive deal flow and going in on these investments every month together as a club. But that's what we got for you today. 9 different ways to defer your tax bill through real estate. Denny, anything you want to add before we call this episode complete?
No, I think you can even check us out without even joining. You can join free and check us out anytime.
And that is a membership level. We do have a free membership level. So if you got a fresh perspective out of this episode, subscribe to the show, pass it along to friends, family, colleagues, etc. And if you want to hear something else, if you didn't get a ton of value out of the show, and you're still listening for some reason, hit us up at support@sparkrental.com. We'd love to hear from you. Love to hear any feedback that you have. And lastly, consider joining us in the co-investing club. And if you're not familiar with the kinds of passive real estate investments that we look at together as a club, we have a free course explaining how those investments work. It's very quick and punchy. Each episode is like 5 to 10 minutes long. sparkrental.com/free. Check it out. We'll link to that in the show notes. And on that note, stay weird, unconventional investor.